Tracy and Bruno, welcome to the show. It's my first chance to chat with you, Bruno, but you know what you're talking about, and we brought you in because two heads are better than one.
Thank you.
I was going through the pre-show notes, and Tracy had sent over the top 10 trending topics for Canadians when it comes to things related to housing and mortgages and rates and the economy. So as I was saying, lots of ground to cover today, but we can dive right in. We've talked about this actually before, Tracy, that anxiety that comes along with mortgage rates. And we know that over the past year, a lot of Canadians have felt that pinch when they're going to renew their mortgages. We've also had numerous discussions around fixed or variable rates as well. And we know that the Bank of Canada has its next announcement coming up in about a week and a half rather, on the 11th of December. Where are we at right now, and what would be the best advice? And I'll put that out to both of you. Best advice for people that are looking to renew their mortgages.
Yeah, thanks, Brock, and it's always great to be on. So much to talk about, right? And we're close to the end of the year. Mortgage renewals is such a hot topic, and will be continuing into 2025. There are quite a few mortgages in Canada that are coming up in the next year, actually the next 3 years. So, working on strategies for people, what to do in this market that's ever changing. And, we're the, I want to be the resource for education for the community,
Absolutely.
right? So that people can really help navigate it. We've got our last Bank of Canada announcement for 2024, December 11th. I think in regards to what that's going to look like, we're going to see a decrease. More than likely, it'll be a quarter or a half. That seems to change every week with a lot of economic sentiment that is out from market experts. I think, we'll probably see at least a minimum of 0.25%. Okay. And we've already had 1.25% drop over the last 5 announcements, which is great news in 2024. Right. It's coming from a far cry of the last 2 years of, escalated increase of bank prime. And it's giving a lot of people that are in adjustable variable rate mortgages relief. Right. I've seen it. I've seen payments go down over $1,100 for some clients with higher mortgage balances. So it's giving a lot of people some relief and some opportunity of, can I look at moving my property? Can I look at selling and upgrading my home into the new year? Do I have to just, stay where I'm at? A lot of people have been staying in their home. Right. Because they haven't been able to move because of high costs. So I think when you're looking at what type of product to take, it really is right now, everybody's financial situation is unique to themselves. And we have to look at not only where they're at, where are their future goals for their families, as an individual, for their financing, but what do they qualify right now, because we're still in a higher rate environment, even on the fixed side. And bank prime still has some movement to go down. So I think that when we're qualifying people, what we'd like to recommend, which is what my choice is, more variable, because we know bank prime's going to come down potentially another 1% next year. You have the option in a variable to convert to a fixed rate. As fixed rates come down, people may not qualify for that because it's still stress tested, right? So there is now new rules that came into place for mortgages that are coming up for renewal, where you don't have to stress test. Right. So that's going to help people look at taking a variable rate, but everyone's case is unique to its own. And that's why I tell everyone, make sure you're calling, make sure you're sitting down with a mortgage professional so you can really understand where you're at financially, so we can make sure you're on that path of success.
And before the show got started, Bruno, you were talking about the fact that the Bank of Canada has come out with these announcements. We've seen the decreases happening, but that fixed rate is actually, we've seen it jumping back up again. Maybe you can walk us through, because we would think, the Bank of Canada is setting the pace here. Everyone else should be following suit, but that's not always the case.
Yes. So people need to understand that there is a difference between the influences of your fixed rate mortgage versus what influences your variable rate mortgage. So variable rate mortgages are influenced by the Bank of Canada. Bank of Canada sets the Bank of Canada rate. Currently, it's 3.75, and then prime is typically 2.2 on top of that. So right now you have prime at most financial institutions at 5.95, and your variable mortgages are hinged on that 5.95. Are you going to get a discount? You talk to your mortgage professional. They can look at the various discounts available given your situation, where fixed mortgages are more dependent upon the 5-year Canada bond yield.
Right.
So what I have here, and I just got it on my phone, October 31st, the 5-year bond yield closed at 3.02%.
Okay.
It went up to 3.3. So that's a 30 basis point, give or take,
Yeah.
increase in the bond yield. So fixed rates are contingent upon the 5-year bond yield and then a spread on top of that. So 5-year fixed rates from October 31st, in many cases, many financial institutions, because of that 30 basis point increase, actually increased their 5-year fixed rate,
Okay.
even though prime had come down a little bit
Right.
given the Bank of Canada. The 5-year bond yield is influenced by the 10-year U.S. Treasury.
Okay.
Because we're so heavily tied to the United States, a lot of what influences the 10-year Treasury, be it the presidential election,
Right.
their job numbers, lately, a big influence was who their Treasury Secretary was. So when they announced their Treasury Secretary, the market reacted pretty positively to
Right.
that, and 10-year yields came down, and 5-year Government of Canada bond yields came down. And it's not to say we're only contingent on the 10-year, because what happened is our GDP numbers came out, and the GDP numbers came out pretty weak.
Right.
We have a
Right.
year-over-year 1% GDP growth, but most importantly, our real per capita GDP has now shrank for 6 straight quarters.
Okay.
And that's pretty negative for the economy.
Right.
And
Right.
because it's negative for the economy, yields will come down because the anticipation is that, the market will react to bad economic news,
Yep.
and the central bank will lower interest rates too. So bond yields came down, and now the bond yield close on Friday was actually 2.95,
Okay.
which is good. That's 35 basis points lower than where
Yeah.
it was just a little while ago. And that's kind of where the fluctuations are. Now, when it comes to a client taking fixed or variable, of course, it's all a risk appetite.
Right.
I mean, you're never 100% certain on variable and which way the rates are going to go. There's some fluctuation. You got to qualify. So talking to your mortgage professional would definitely
Makes
be
the most
something
sense.
that makes sense.
That brings up that point too, Tracy. Do you find that is there a sort of is it a tough sell when you're dealing with maybe older clients where they're looking at they want to know that they want to take as little risk as possible because of the fact that maybe their income is stagnant or whatever. Is it a tough sell sometimes, or?
It is. I think it's a tough sell for a lot of people right now. I think we've had high inflation. Everyone's feeling it in their pocketbooks, just going to the grocery store, to getting gas, to buying essentials. It's expensive. And I think that the conversation, I've been, a mortgage broker and in this space for 26 years. And I feel that I've always been a big fan of variable because I think statistically over the years, people will save thousands of dollars of interest just by taking a variable. Usually the trend is it is lower than fixed rates, especially with the discount. And then you also have the opportunity to convert it to a fixed rate when fixed rates are at a lower point. But, we've had 2 years, almost 3, let's say, of, exponential increases in bank prime that we historically, for most of us, haven't seen before. And it's really affected people's financial well-being. So that there's a scarcity mindset of, I don't want to go through that again. We're going to end up in this high escalated environment again. I mean, no one has a crystal ball, but typically when you look at the trends, and Bruno can talk on this because he's got some great charts of showing some previous times in the economy when we've hit, a high inflation times. And when we've actually, when that cycle has peaked, we usually see 12 to 18 months of rate reductions. And we usually see that being about 2.5% lower for bank prime. So we are in that, we are in that kind of, disinflation environment right now. And I think, we're on that cycle of rates coming down, and the forecast into 2025 is promising to still continue to see this. So I think we have to look at it in a different lens, educate clients a little bit more with some very basic perspective on where it's going and how much that's going to impact them. Not necessarily today, because today it's still a higher rate. So if you're taking a variable, it is going to be higher than where fixed rates are, even with the discount, but knowing where it's going to go and showing people the difference, because when you're looking at it, it could be a difference of on a $600,000 mortgage, with where we're going to see potentially bank prime go, if we do see that 2% drop between now, like what we've had these last 5 announcements till next year, that could be almost a $700 reduction in your payments. That's massive. And then you can take the option of switching to a fixed rate. So it's a win on everything. It's just spending time as a mortgage professional, really making sure and listening to your clients' needs, but also explaining where we are in the economy and where we're going.
To both of you again, we know that that Canadians we're all dealing with a housing affordability crisis. We talked about what we're seeing in different cities and communities across the country as well. Where do we stand right now, and how do we sort of manage where we're at? And as we've said before, we don't have that crystal ball, but what are some of the steps that we could be taking as we move into the future?
Do you want to start, or do you want me?
I mean, I can talk about the data.
Sure.
And so when we look at housing affordability in the Waterloo region, and we can look at average prices, I mean, in January of 2020, the average price of a home in the Waterloo region was about $570,000.
Right.
It went up to over $1 million February 2022. So if you say, are houses more affordable today than they were before? Well, if you say February 2022,
Right.
you're paying $1 million for your home. You would have had to have put 20% down. That's a $200,000 down payment. October of 2024, fast forward, and the average price in the Waterloo region is about $780,000 now.
Right.
And of course, you can go in there as a first-time home buyer. You don't have to put 20% down. You can put 5% of the first 500, 10% of the remainder down, and so on. So in terms of housing affordability, it all depends on what you're comparing it to. As we talked about before, it all depends too on your interest rates. Mm-hmm. And we know historically, when rates come down, values are typically, there's pressure on rates to go up.
Right.
And then when rates went up, values, of course, after 2022, the Bank of Canada started increasing rates. The average home prices started to trend downwards. So there's a lot of good news coming out, and Tracy can definitely talk about what's happening in terms of some of the rule changes that'll help people qualify a little bit better as well. But it all depends when you're comparing to. So I would say that if you were looking to buy a house today at $780,000, it's a little more affordable than it would have been in February of 2022 when the average home price was $220,000 or so more. Right. Even though you might have got a lower interest rate back then, your mortgage balance is much higher, your down payment requirement would have been much higher. So the affordability is kind of like you got to balance that out. But I think every situation is unique. Of course, that's why you contact your mortgage professional, and they'll look at your income, they'll pre-qualify you, they'll look at your situation, what do you have for a down payment. December 15th, we have some new mortgage rule changes coming out, and I'll pass it over to Tracy to talk about that.
All right.
So I think that I'm very optimistic into next year. There's actually really in the middle of December of this year and going forward. I think the federal government has recognized that first-time home buyers and buyers are struggling to be able to qualify to purchase homes. And especially when you look at it from a builder's perspective, there's a lot of builders that have not been able to move their inventory because individuals and families have not been able to qualify, specifically because of rate, but also because of the costs of the homes and the builder's costs that are actually then being passed on to the consumer, right? So, I mean, hopefully, and that's a topic we can chat about, I think, during the call too, is like the cost of like what it is for a builder to complete a home, right? And how much that's gone up and how much that's impacted. So I think that when you look at it, and we'll talk about a lot of these rule changes, we haven't seen so many rule changes from the federal government historically in such a short period of time that we've seen in the last few months. That are coming into play. One of the first ones is just that recently happened was the elimination of the stress test, right, on uninsured mortgages that are coming up for renewal. But we also had that removed off of insured mortgages that are coming up for renewal. So it's very confusing for homeowners to understand what that rule is. That's what I always say to clients that are coming up for a renewal. Make sure you speak to your mortgage professional, right? So
Yeah,
you can navigate
exactly.
that to make sure, because it is a big difference on a rate to help you get into potentially a better lender and a more competitive interest rate. But the next one I'm excited about is the December 15th rule. And that is for first-time home buyers or buyers that are purchasing a new built home
Right.
can qualify from, traditionally it was prior to December 15th, you could only go up to a 25-year amortization. And if you had less than 20% down, and the cap was $1 million, right?
Right.
Now it's gone up to 1.5 million, which is great for some of these higher price point areas like Toronto and Vancouver area, actually even surrounding when you think about it, in Ontario specifically. You can now put down less than 20% and you can go to a 30-year amortization. So I did a bit of a scenario. Now I only use 650,000 because that is like a starter home for us here in the KW area
sure.
now.
Yeah.
So if we looked at that prior to the rule change, December 15th, you could put down a minimum of, it's not 5%, it's a sliding scale like Bruno said. It's 5% for the first 500,000 and then 10% for the amount remainder. So it works out to be about 6.15%, which equates to 40,000. And I'm going to use right now, our competitive rate is 4.49 on a 5-year fixed. On a 25-year amortization, your payment's $35.07 monthly. Okay, that's your mortgage, that's your principal and interest monthly payment. Now, fast track to December 15th, same purchase price, 650,000, same down payment, so 6.15%. Interest rate's the same, 4.49%, but the difference is your amortization's 30 years. Well, your payment actually comes down $306 a month. So it's $3,200, and we could say, well, that's not a big deal, but it is for first-time home buyers. It actually is for a lot of buyers because every penny counts nowadays, right, with inflation. But the biggest news on that is income requirement. Your income requirement has come down from originally on the 25-year amortization, which would require you to purchase that $650,000 home with minimum 6% down payment. Your income required annually is $143,000. Now that's come down to $116,000. So $27,000 less you need. Well, that's a huge deal because the average income in our area is about $60,000. So when you look at it for a couple buying a property for $650,000, what's happening is they're not able to qualify for that home for best rate. So one, they either have to get a mortgage helper, which is go to mom and dad, ask for more money down. And when you look at it across Canada, statistically, the down payment minimum that first-time home buyers put down isn't 5%, it's actually 13%, which to me leads to they need to have more money. They need to get, you see more parents gifting it, or they need a co-signer, like a parent gifting it with that additional bump of their income. So this is going to help a lot of people not only qualify for more of a purchase price, but also manage that payment more, right? Because the payment's down, which is a huge difference. So that's a big win. I think that's coming December 15th. And people could say, well, it's, it's not going to make a big difference. But here's, I've given you a scenario there. And that's just again, an entry level home, right? So when you get the higher price you go, the more your payment will come down.
Well, and it, you talk about the fact that if you're a first-time home buyer, it's it's a starter home. You can use that term. It does free things up a little bit, and we've talked about that fact, right? People look at in a lot of cases, what do the next 2 weeks look like? What does the month look like? At the end of the month, what have we got? What have we got left in the bank account? And if it's a difference of $300, that can make a big difference for a lot of people. The home prices have come back down after February of 2022, but we might still have that a certain pocket of the population who are either renting or they're moving out for the first time from their parents' home or whatever their situation is, and they're looking at renting and they're looking at buying. Is there still an argument to be made for renting in this climate, or is it more likely to? I've always thought if you can get your foot in the door, right, and get yourself into the market, it's going to make life a lot easier down the road. Yeah.
I'll leave it to you, Bruno.
I mean, every situation, of course, again, is different.
Right.
When it comes to home ownership, obviously the advantage to home ownership is you've invested in a property.
Yeah.
You own the property. As you amortize that property, that mortgage down,
Right.
and if that property grows in value, you're creating some wealth
Right.
in equity in your property. Whereas if you rent, that's not the case. And I know Royal Bank did a study a while ago, and they indicated the difference between wealth creation for homeowners versus those that don't own a home, and there's a substantial difference
I remember
between the
that
two.
report. Yeah,
Yeah.
absolutely.
So owning a home, you're investing in a property, you're paying down your mortgage. As you pay down your mortgage, all things being equal, you're building equity and you're building net worth for yourself. And that's important to know, but of course you have to then qualify.
Right.
Your mortgage professional will look at your situation, look at your down payment, look at what your payments are overall, depending upon the interest rate that you have. And if you're able to get into a home ownership situation, then you get into that situation of being able to build some net worth. Challenge is these days, it is difficult to qualify.
Mm-hmm.
I mean, that's why mortgage professionals are so important, to be able to go and talk to them, get pre-approved, find out how much you qualify for. And even the rental market, we know, is not the easiest thing in the world these days.
Right.
It can be very challenging just to find something to rent because we have such a shortage of homes in this country, and it's not just Kitchener, it's of course across Canada, be it for home ownership or for rental. There is a housing shortage, and we know that. We talk a lot about that, we hear a lot about it in the news. We need to build more homes, we need to build more rental properties, we need to build more apartments, we need to build all kinds of different properties. So certainly as supply increases, both of rental homes and owner-occupied homes, then that should put some downward pressure on overall prices. It's a supply and demand issue. Mm-hmm. But right now we do have those shortages, and when you have shortages, you have upward pressure, right, obviously, on price.
Actually, when I was looking at a study last week, they said Canadians age 18 to 43, 58% of them still aim to buy a home in the next 5 years.
Okay.
And to me, that's promising given the challenges. I think that age group is more educated on where we're at from an economic perspective because they're feeling how expensive things are. Just even maybe going out to a restaurant or
right.
Going to get some quick food somewhere, right? It's not cheap anymore. Putting gas in their cars, trying to find a job, right? So I think that when I've spoken to a lot of clients that were renting before buying, even renting has become super challenging to qualify. It's not just about a credit check, right? Some landlords wanted like 6 months advance of rent, and I think that's slowly changed because we're starting to see monthly rent come down a bit. I think that the demand isn't as great as it was. Maybe people are staying home longer with their parents. I'm seeing that as well. But I also think, to Bruno's point, there's going to be maybe a bit of a correction on values on certain types of properties. I think condo market is going to be super interesting over the next 12 to 18 months. There's a lot of pre-construction condos that are going to be completed. And in fact, there was a report I was seeing, there's like 30 to 40,000 units in the GTA area alone.
Okay.
And we've already seen over 900 units that are up for sale right now with a price reduction.
Okay.
So the amount of supply of condos, especially even in our area too, is over 5 months supply. So those values will come down a bit, and that will help first-time home buyers get into, which has been traditionally that entry point,
right,
is a condo or a townhouse. So with interest rates coming down, these new rule changes coming into place, not having to come up with as much down payment because your incomes become less in terms of qualifying as rates come down, I think it's going to help people not stay in that rental sector longer. The longer you stay in it, I think the tougher it's going to be for you to qualify unless you have a change in income or a mortgage helper like a parent, because paying a minimum of $2,500 a month on rent, I don't know, it's going to take you a lot longer to save up the money, right, on top of everything else.
And I've had this conversation with some other people about the idea of people that are they're getting close to retirement. They've got children that are say in their 20s and looking to leave the nest, and the idea is that a lot of people are starting to look at, well, instead of waiting until I pass away, what are the things I could be doing to helping out my children to get on their feet right now. It's honorable to be able to do that, but also you don't want to be putting yourself in any sort of financial jeopardy. But that's where we find ourselves.
100%. And I've seen a lot of parents have to give their inheritance early. So refinance their existing home to be able to pull out the equity to help their children. And I've seen some, older couples that were looking to retire are not going to be retiring now because they're helping their children, or looking at maybe changing the existing house and make it more of a generational home, right? Adding in an income suite, adding in, an addition onto their house so that their children can stay there longer, because it's become more challenging. I think, to your point, it's changed where people are retiring, right? I think we're an economy that's based on, we function better on lower interest rates. And I'm not talking about the extreme of the 1.5 or 2% rate.
Right.
But if you go back to 2019, which I know Bruno has talked about a lot in his presentations, and you can speak on that, Bruno, we were, the economy functioned better than on those type of rates. And we were sitting at, rates of 3.5, right? We were functioning better at that. That's not bottomed out. When we talk about lower rates, we don't have to go to the extreme. And I think people have to know there's a middle ground there. And hopefully this government and our economy can get to that middle ground.
Yeah, when it comes to 2019, and I just want to comment on that, what I said. In the article says Canadian homeowners' net worth 4 times higher than renters' distribution of net worth per household as of Q3 2023. So that's the study I was kind of quoting when I talked about home ownership versus renting. So when it comes to 2019, and we look at what Tracy's referencing, the Bank of Canada in 2019 was 1.75.
Right. Yeah.
The Fed in the U.S. was actually at 1.75. This is as of December 2019. The inflation rate in Canada was 2.2. Right now it's 2, the last reading we've had. So it's a little bit lower than where it was in 2019. In the U.S. it was 2.3, now it's 2.6. So when we go back to 2019, I think we were doing 5-year fixed rates. Remember, this is the 5-year fixed rate mortgages. We're in and around the 279, 289 range. And of course, now they're much higher than that. So yes, the market was pretty healthy back then. I think from a supply and demand issue, I think from shopping around for a house, that was good. So will the central bank lower to 1.75? We of course don't know that. Right now, the Bank of Canada is at 3.75%. December 11th, they're going to meet again. But it wasn't that long ago that interest rates were very low. Remember, the 1.75 is the Bank of Canada rate. You add 2.2 to that, we had prime at 3.95. Now prime is at 5.95, Bank of Canada 3.75. As I was quoting earlier, those rates I was talking about were the 5-year bond yield rates. The spread on that, of course, the 5-year fixed rates are going to be much higher than where the bond yield's at. So I just wanted to clarify that. And that's where you talk to your mortgage professional to find out if fixed or variable is better for you. So yes, in 2019, not that long ago, we had a pretty good economy. Supply and demand for homes, I think those of us that were in the market back then, it got crazy in 2021. We had these multiple offers, like 40, 50 offers. It was crazy. Everyone was outbidding each other. The market has somewhat settled down, but in 2019, even though rates were very good, we did have a fairly strong real estate market and a pretty decent economy.
And you've talked about this, and Bruno's mentioned it a few times, that idea, making sure you do check in with a mortgage professional, and we know a few. We've got one right here in front of us. Tracy, would it, can you imagine that there would be those people that would come to you and say, look, I am renting right now. Can we take a look at there's got to be ways to get me out of the rental market and into ownership. If they're coming to you, what sort of homework do you want them to have done before they come and have a chat with you?
Yeah, it's a great question, Brock. A lot of people, when they come to see us first, and don't have the conversation, don't have the documentation needed that we need to look and review at to be able to get them pre-qualified for a home. So making sure that we sit down up front or have that call or, virtual meeting
Right.
and go through exactly how you're getting your income, because people nowadays don't just have one job, they have 2 to 3 jobs. And they're receiving income in various ways. It's traditionally not even that, what we used to see, that full-time permanent employment. We're not seeing that. We're seeing casual, we're seeing online income. What does that look like? How are you receiving it?
Right.
Are you, permanent, full-time? What type of employment are you? Are you seasonal? So really understanding where your income is, how you're receiving it, so that we can gather the proper documentation and set the expectation of realistically where that income is going to help qualify you, as well as down payment. We have a lot of new Canadians that have come into the country, but still have money that are in other countries where they
Right.
originally came from. So, what does that look like to be able to move that money, and can we have the trail of seeing the history of the money coming into Canada, so that we're adhering to all the federal legislation that we have, right? For mortgage financing. So educating people is key, making sure we get the proper documentation. Credit, as always, and I always have said, is one of the number one, I think, drivers of a pre-approval, knowing what your credit score is, and we go through that. So we pull credit right up front with the client's consent, going through what they have or what's limited on their credit. Maybe they need to establish more credit to help them get into home ownership. So it's spending a lot more time on that initial conversation and appointment, so people have a realistic expectation of what's required to be able to buy a home in Canada, and also the timeline, because maybe they need to repair some credit items on their credit score, because we can do that and it can be done quite quickly depending on what's showing on there, so that they can get into home ownership. But I've seen over the last, I would say, year, a big transition on how many people have more than one job now in Canada to survive. So how do we use that? And if we can't use it, is there an option where we can get a co-signer, right? Parents.
Right.
And also having the conversations, it's not for the long term. It's to help you get into the home.
Yep.
The expectation is your income will increase every year based on with your employment. Values will go up, you'll build more equity, and we can look at potentially getting your parents off, or getting an income helper, which is adding on an additional income suite. And we can get into some other rule changes that are happening in the new year as well to help with that.
Where we kind of see what's going to be happening, and what the influences are going to be at that point. Not crystal ball necessarily, but the influences that would be out there.
So when we head into 2025, December is going to be a very busy month. We have the Bank of Canada. We discussed that on December the 11th. The Fed in the United States, which of course influences Canada quite a bit, is meeting on December the 18th. But we also have things that will influence, as I said, those 5-year bond yields. We have inflation data coming out. That's coming out on December the 17th. In the U.S., we have inflation data coming out that has implications to Canada's bond yield rates. We have some employment data also coming out of the U.S. in terms of their payroll numbers, and that's coming out on December the 6th. So these are big data points that typically the market looks at, and we'll see reactions on bond yield rates, be it up or down, depending upon the nature of the news. Typically what happens is if you get bad economic news, bond yields go down.
Okay.
And it's not to say it's kind of hard to cheer for bad news, but if you get bad news, and we got the bad news on the GDP numbers,
Right.
and what happened after that bad news, Canadian 5-year bond yields came down. So bad news being good news, typically for mortgage interest rates, these are some of the economic announcements that are coming out for the remainder of this year that, of course, will lead into January 2025.
When the bad news drops or the good news drops, how long are we talking before we start to see changes in those rates? Is it
Immediate.
Immediately?
I will watch it in the morning, and typically these data points come out at 8:30. So you get, like say the non-farm payroll numbers in the U.S. That comes out at 8:30.
Right.
Immediately after that, within minutes, you will see reactions on bond yields.
Okay.
right after that announcement, because the market's waiting for the number. The
Right.
number pops up, and then they
they
start
keep going.
reacting, selling, buying, depending upon what the nature of the news is. So that reaction is pretty much immediate.
Okay.
But then it lingers. It might go on for a couple of days, but
Right.
the initial reaction is very quick.
All right.
And actually, a question on that, Bruno, because I bet you listeners are probably thinking, well, what does that do at that point on fixed rates? How long does it take the lenders to potentially change them?
Well, the lenders have to look at what their spreads are. So depending upon what the 5-year bond yield comes in at, right now it's about 2.95, 3.
Yeah.
So you're going to have a spread on top of that. So
Right.
your 5-year fixed rates, depending upon is it insured, uninsured, all those other things, you should contact your mortgage professional to discuss. But the lender will look at the spreads and then react. Was there some room? Was it narrow at the time?
Right.
And then they'll look at their overall profitability in terms of that spread. And, it might be that day they change their rates.
Okay.
It might be a few days down. It all depends on the individual lender, what their profit margins are, and their reactions to it, depending upon where they need to be. Sometimes you get market share battles.
Right.
And when you have market share battles, that's great for the consumer because they're battling for market share, and the spreads might not be so great because they just want market share.
Right.
And then other times, it's different, so it varies.
That's why you got to speak to a mortgage professional.
Yes.
And also, we've got spring market coming up, right? Which realistically,
Right.
for us here in Canada,
That's a
is
good
at
point.
the end
It's
of
busy.
January
Yeah.
or February. To your point, Bruno, market share that's usually when it becomes competitive, and these banks and lenders, financial institutions, credit unions will start being more competitive on rates. And we did have that this year, which was exciting to see, right?
Yeah.
So I expect to see that next year as well.
Bruno talked about the fact that December is going to be busy. When there's all of this input and data that's going to be coming in. It sounds like you're going to be busy as well with a couple of other projects on the go, Tracy. What have you got happening in the next little while?
Well, as you know, with us here at Valko Financial, we're always helping and contributing to the community and making impact. So we've got two big events that are coming up in 2025. We've got the Family Day Skate we're bringing back, which has been a few years. It was on hold since COVID. I can't really believe I'm saying that, but it's been that long. So that's February 17th, 2025 at Sports World. So, we'll be having some advertisement and putting it on our website for people to register. It's a free family skate from 10:30 to 12:30 at Sports World Arena. So that will be fun. We'll have lots of food there for the kids. And then our second annual mental health fundraiser, the Stronger Together Care Never Stops Foundation, where we partner with the Grand River Hospital. Well, it's combined now with St. Mary's, which is amazing. And
Very good.
it's exciting news because they're building a new hospital. So this will help in terms of raising funds for the mental health division, which is a much need of funds and resources because not only do they serve our community, but 1 million people outside the community, which is incredible. So we're going to be having that event on March the 6th, 2025 at the Tapestry in Cambridge. We're expecting, our goal is to hit 500 people in attendance and raise a lot of money. So we've got the information, we've got it out on our website. I'll be promoting a lot of that over the next few months as well.
Okay. Are you looking for donations when it comes to the event in March, or what?
Absolutely. So it'll be
Okay.
donations. We'll have a 5-course dinner again, like we did last year. So there'll be ticket sales to attend the evening. We'll have entertainment. That will be exciting to announce who that will be in the future. Can't say anything right now.
No, tune in.
But we'll have silent auction items, and then we'll have corporate table that we're selling as well. Sponsorship levels, again, every way that we can assist to raise funds and give back to the hospital.
All right. When February 17th rolls around, are you a skater? Or either of you going to be strapping the skates on?
Well, I did last time I did. I could say I'm a fairly good skater.
And
Bruno.
Bruno's very
Boards
quiet.
assist. The boards will assist her skating abilities. So just stay close to the board.
Good idea. That's the safest
I
place
have
to
not
be.
skated, I don't think, since the last time we had it,
Yeah,
which
but you
was
were
in
out.
February of 2020.
Yeah.
I think was the last time Tracy had her family skate. So that's probably the last time I put skates on. So I will probably put them on. I'll wear a helmet just in case. It's been a while, so I'll make sure.
Yeah.
Not the Great Escape.
Bruno, thanks for coming along with us
Thank you.
today. And Tracy, always a pleasure to have you on the
Thank
show.
you.
Thanks for giving us some of your time today.